We are starting topic 14, and this is the final topic, as I told you, and we are coming full circle. Way back at the beginning of the school year in early September, we talked about these two financial statements, the income statement and the balance sheet. They were much simpler then, and we've gone through quite a bit with the accounting cycle with journalizing and posting. The most recent problem dealt with the highlighted areas of the balance sheets that you are looking at on your screen. We looked at putting sales discounts, returns and allowances, same way with purchases and discounts and returns and allowances on the income statement. And over on the balance sheet, you had to put in from the general ledger accounts receivable and the allowance for uncollectible accounts, and also the accounts that we classify as plant assets, office machines and truck in this case, and their depreciation accounts. So those we talked about quite a bit in recent topics. Now I want to focus on just part of the income statement at this point. So let me go over to first the balance sheet and get rid of our highlights. Same way on our income statement. So we're going to focus right now in topic 14 on this part of the income statement. Cost of goods sold. Way back in topic 7, we talked a lot about cost of goods sold. Remember, first in, first out, last in, first out, in determining the cost of goods sold. Now we're going to add a few more wrinkles to that and take a look at this section of the income statement. Now we're going to look at just the end result here of some calculations that had been done for the ABC bookstore prior to the construction of the income statement, as we'll see in just a moment. But now we're looking at cost of goods sold that involves merchandise inventory on May 1. This is the beginning of the accounting period. As you see at the top, the income statement is made for the month of May, so their income or their accounting period is 1 month in length. So this cost of goods sold is going to show us the inventory that we had. Now, the merchandise inventory would indicate those things that we're going to sell. So merchandise inventory on May 1 was valued at $67,000, and that's the amount that would be in that account. Now, in recent problems you didn't deal with this account. You did deal with purchases. You learned about a purchases journal, and we had some problems where you showed purchases on account, and we added to that account in some of the problems. So this number would indicate the amount of purchases made during the month of May. Purchases of merchandise, but that information is put into this account called purchases. So that amount, as we see, would have come from the general ledger, and the amount of $40,870 would have been a debit on the purchases account. And we also learned that sometimes there are purchases discounts. In other words, if we pay early, we can deduct. So this 1935 would be a deduction. Same way with returns and allowances. Apparently we returned or got allowances of $500 for something that was damaged or something that we returned. These two would be subtracted from the $40,000, giving us a net purchase amount of $38,435. Now, when you add the net purchases that would be found after this little calculation of deducting discounts and returns and allowances, we would add that $38,435 to the original merchandise inventory, and that would be part of an adjusting entry that we may not have time to get to, but it would involve adding this amount to the original merchandise inventory, which means we had available for sale during the month of May a total of $105,435. It would consist of the merchandise inventory we had at the beginning of the month and the net purchases that we acquired during the month of May, adding the two together. Then, something new that we haven't talked about in this course yet. This involves merchandise inventory on May 31st at the end of the month, $64,310. Now, if you would go back into the ledger, you would not find that amount of money anyplace. So another step that needs to be taken by somebody in the business is to do what we call an inventory count. You may have heard of businesses sometimes taking inventory, which means they literally count what they have on the shelves. They add up what they have, and in this case, an inventory amount has been taken, and that information is given to the accountant, and that can be plugged into the income statement, totaling $64,310. So that's the amount that we have left. So we had amount of inventory available for sale of $105,435. At the end, we have still on the shelves unsold merchandise inventory a little over $64,000. If you would subtract that, then you get something that we've talked about before, cost of goods sold. So this is a different way of determining that amount of money. The cost, our cost of the goods that we did sell cost us $41,125. So again, as in past videos, you may want to walk through this again by pausing and going back and making sure that you understand the process in this section of the income statement. The bottom line is we end up with cost of goods sold. If we subtract that from the net sales, then we get gross profit. And this is the section we'll be dealing with in the next couple days. Just to review, once again, we do have an account in our general ledger called merchandise inventory, and that would show a debit balance of $67,000. And that would go back to the beginning of the accounting period, in this case, May 1. We've had a lot of problems and a lot of experiences in working with purchases where we bought merchandise, and we talked about discounts and returns and allowances, so this much you've been dealing with. But we haven't touched the merchandise inventory account. And at some point at the end of the accounting period, the business has to do what we term taking inventory. In other words, literally counting what's on the shelves, and some of that can be done automatically through our computing system, but we're not going to get into detail with that right now. But basically, we need to have an actual count of what we have on hand at the end of the month. And if we subtract that from the amount that we had available for sale, then we come up with the cost of goods sold. So this is the new section highlighted in yellow that I want you to be aware of and be able to handle when you construct an income statement. It's a little different than what we've had before. So the determination of gross profit involves everything that's highlighted in yellow here on the income statement. Once we find that gross profit amount, then we will at the bottom subtract from it the expenses, all of the expenses that you see here, adding up to a little over $69,000. When you subtract the total expenses from the gross profit, you will get what we call the net income. So it's a little more complicated than the income statement we looked at way back in September of this year. So this will be the final part of what we talk about in the course, and it goes back to, as we said, full circle to the financial statements. One more point I want to show you here, and we'll talk about this perhaps a little later in some problems. Somehow we end up with an ending inventory after we take account of all the things we have on hand. It also ends up over here in the balance sheet. Whoops. The balance sheet shows us $64,310. And that's as a result of taking inventory. That's what we have on hand as of May 31st, 2019. That's the value of the merchandise inventory, and that's part of the balance sheet. At this point, there'll be a few questions I want you to answer, so let's do that now.